Should someone remind me, but it's okay. Okay, I repeat again the lecture a little bit. Okay, financial leverage is about cost control. Okay, so in terms of cost control, the companies have their own objective in controlling their cost. So how to control the cost? Usually by maximizing the revenue and minimizing the cost. And how they want to maximize the return and minimizing the cost by controlling these three types of cost, which is cost of goods sold, which is cost related to purchasing raw materials and updating their inventories. The second one, operating expenses, which is internal expenses inside the company, for example, salary, yeah, and the utilities, account receivables, prepayments, and so on. And the last one, interest, whereby companies sometimes need to pay to banks or finance company because they are taking borrowings or financing from them. Okay, so the reason why cost control is important because almost every day, yeah, the company will do some purchasing and will do some collections. Yeah, so that's why the factor of magnifying these three factors in which is in because of using of fixed cost asset. Okay, so fixed cost asset usually in terms of machine, in terms of land, plant, factory, yeah, and then vehicles. Yeah, so the formula is simple. Yeah, if you use more of fixed asset, yeah, the current liabilities and current asset will become increases as well. Yeah. Okay, we have three types of leverage, which is three types of cost controlling. Eh? Okay, the first one is operating leverage, which is the company is controlling the cost of operation, which is concerned with the relationship between the first sales revenue and EBIT, which is earning before interest and taxes or operating profit. Okay, which is if you see this one, yeah, that means they are trying to control from the sales part until cost of goods sold and then operating expenses. So they are controlling in this part only, which is in terms of operation until EBIT. Okay, what I'm saying here is you're talking about operating leverage. Yeah? Remember, you need to maximize sales and minimize cost. So in terms of sale, they're trying to achieve as higher sales as possible. And then at the same time, they try to reduce as much as cost of goods sold. Okay, so one of the alternative of you can control cost of goods sold is maybe before this you purchase a very what we call premium raw material. Yeah, but for the sake of cutting the cost, maybe they are trying to shifting from premium product and to become an ordinary product maybe. Yeah. Okay, and then at the same time, yeah, which is less operating expenses means that you try to cut costs in terms of operation. For example, reduce employee salary, reduce utilities, and probably reduce so-called as marketing and advertising expenses. Yeah. So if you are able to control the cost, which is maximize revenue and less in the cost, so you can get the very good of earnings before interest and tax. Okay, I give you a numerical example. Okay, let's say sales revenue is 500K, and then let's say cost of goods sold is 100K. I give you a numerical example. And then you have operating expenses of another 100K. So that means your EBIT will become 300,000. Okay, but what happens if we increase sales revenue and minimizing cost of goods sold? Let's say, for example, from 500,000 to become 600,000. And for cost of goods sold, we reduce from 100K to let's say 50K. And then for operating expenses, you also reduce from 50 to 70, for example. So what will happen is, yeah, 600,000 minus 30,000, sorry, 50,000 plus 70,000, you get 480,000, which is better from the previous ones. Okay, so that is how leverage works. That means in order to generate desired revenue or profit, they try to control whatever items inside the income statement. Okay, that is the first thing. Wait, Okay, there might be something. Okay. Uh, just to check. Just to check. Okay, I think everything is good. Okay. The second part is financial leverage. Financial leverage mean which is a controlling cost in terms related to finance matters. Okay, so it is a relationship between EBIT and its common stock earnings per share, which is EPS or net profit. Okay, that means if you see in this one, yeah. All right. So financial leverage, which is company is controlling from earnings before interest and tax until earnings per share, which is profit. Okay. Illustration is this one. Let's say before that we got 300,000 earlier. Okay. And then this one we got 480,000. Okay. For interest, let's say previously you have to pay interest of 10%, which is 30,000. Okay. And then you get around of 270,000. And then taxes, yeah, because you have to pay taxes to income tax. So let's say you have to pay let's say 40,000. So that means you get here net profit of 230,000. Okay, your level is usually until net profit only. Okay, but let's say if company is what we call as a have a new alternative in finding financing from the new bank. That means refinancing. Refinancing means that they are taking a new loan from the previous loan. Okay, let's say this company has settled all the financing already, and then they want to refinance the new one. And it found out that the interest is only 10,000. Okay, which is lesser than this one. So you get here 470,000. Okay, and then taxes, yeah, you found out that let's say sometimes tax you can is fixed, yeah, because income tax is already fixed amount, let's say 400,000, 40,000. So you can get here 40,000. So that means 43,000, 430,000. So therefore, from 230,000 until 430,000, yeah, with the leverage, you can get a lot of net profits here. So that is how leverage is all about. Yeah, you controlling this one. Okay, how do you want to control this one? You need to look back at the fixed asset that you have. Okay, so that is how leverage is all about. Sorry, and the last part. Total leverage. Total leverage means that you control everything. Okay, you guys you can see here this total leverage. That means you control from the first part until net profit. Okay, so that is a total leverage. That means a combination between operating leverage and financial leverage. Yeah. Okay, and let's have a look at some of the formulas. Okay, so for leverage analysis, which is we have three, remember, which is operating leverage, financial leverage, and total leverage. For operating leverage analysis, yeah, the potential use of fixed operating cost to magnify the effect of changes in sale of the firm's EBIT. Yeah, that means the analysis of degree of operating leverage, which is DOL. The formula is okay. They have two formula. You can use either one and see how it goes. Okay, which is either percentage change in EBIT divided by percentage change in sale, or gross profit divided by EBIT. EBIT means that earnings before interest and tax. This one. Okay. The second part, financial leverage analysis. Okay, so we call it as a DFL, degree of financial leverage. The formula will be percentage change in EPS divided by percentage change in EBIT, or EBIT divided by EBIT minus interest. That is the second part. And the last part, total leverage analysis, which is degree of total leverage, which is everything here, which is combination of DOL and DFL. So therefore, the formula will be percentage change in EPS divided by percentage change in sale, or DOL multiplied by DFL. Okay, how do you get DOL and DFL? Yeah, you need to calculate first these two. Okay, so you can have those answers. All right, I didn't put any example yet, but I'm sure I will show to you in the study question. Yeah. Okay. All right. Any questions so far? Any questions so far?
No, sir.
Okay, everything is okay. I hope that's good.
Sir, may I have the class code?
Who's that?
Halima.
Halima. I thought you were having here already.
I was there, but I went out mistaken.
Oh, okay. Yeah, here it is. You can have a look. I copy and paste inside the this one. Have a look at the chat
Thank
box.
you, sir.
Yeah, all right, welcome. Okay, thank you. Okay, let me demonstrate to you on how to calculate financial leverage. Okay, I give you the standard question once. Let's have a look at the last question. Okay, the last question is question number 6. Yeah, I think question number 6. Okay. Okay, so question number 6, yeah, if you look at this question thoroughly, yeah, at the same time, yeah, Abang Jamil also has to analyze the financial leverage of the company in order to magnify the desired net profit. Below here is the income statement information for the year 2014. Okay, so we have sales less variable cost become contribution margin, less fixed cost will become EBIT, less interest to become earnings before tax, and then less tax become net profit. Okay, some of the things that you need to understand is, okay, contribution margin. Okay, if for your information, contribution margin we call as a another term we call as a gross profit. Okay, that is what you call the other name for contribution margin. That means yeah, the margin or the gap between sales and cost of goods sold, yeah, which is variable cost. Okay. Fixed cost is usually in terms of operating expenses. Yeah, because sometimes they need to pay by fixed every month or every year. All right. So the first question is calculate the degree of operating leverage. Yeah, which is DOL. Okay. Refer back to the notes. Yeah. How to calculate this DOL? Okay, DOL. The formula is gross profit divided by EBIT. This one. Gross profit divided by EBI. That's the first part. That's the point. Okay, so all right, in this question, gross profit, which is this one, gross profit. Gross profit, the other name is contribution margin, which is 1,200,000. This one. Okay, EBIT you already having here, which is earnings before interest and tax. Yeah, in this case, 700,000. Okay, so you get the answer of, okay, what? If you press the calculator, okay, the answer will be in 2 decimal points only, 1.7. Okay, there is no specific unit for. Okay, okay, that is the first part, yeah, degree of operating leverage. Okay, the second one, the second one, estimate the degree of financial leverage, which is DFL. Okay, as I can remember the formula, okay, so the formula is EBIT divided by EBIT minus interest. You need to check back at the notes. So this is the formula, EBIT divided by EBIT, yeah, divided by EBIT minus interest. Okay, going back to the information, EBIT is this one, 700,000 divided by EBIT, 700,000 minus interest. Interest is this one. You see here, less interest. Okay, ignore the negative sign. Yeah, negative means minus, but the amount of the interest is 300. So you should get your answer of, okay, you need to solve this one first. Yes, 700,000 minus 300,000, and then 700,000 divided by that one, which is 700,000 minus 300,000, 400,000, right? So 700,000 divided by 400,000 become 1.7. That is the second part. Okay, the third part, the question says that the third part is a degree of total leverage. Compute the degree of total leverage. Is DTL. Okay, so DTL, the formula is simple, which is DOL multiplied by DFL. Okay, so you got the answer of DOL already at question A, which is this one. And then you got the answer in this one. So what you have to do, just multiply those two, 1.71 multiply by 1.75. So how do you get the answer? 1.71 multiplied by 1.75, you get 2.99. Okay, so that means 2.99 times the degree of leverage. All right, the next question, yeah. If EBIT increased by 35%, how much the percentage change in EPS? Okay, some of the students, they confused and have no idea on how to answer this one. Okay, let me tell you. Okay, we have this component EBIT and we have this component on EPS. So, just state in mind that, okay, we have EBIT and we have in EPS. What is the formula that have those two? Which is, what is the formula that have EBIT and EPS all together? Okay, let's check. This one EBIT and sales. But the problem is this one EBIT and EPS, so we cannot use DOL. How about this one, DFL? We have an EPS, we have an EBIT, which is, yes, we can use DFL. How about this one? EPS and sale. But here, EBIT and EPS. So we cannot use DTL. So therefore, we can use DFL to calculate the percentage change in EPS. So DFL, yeah, which is equal to percentage change in, I need to check back the formula, EPS and EBIT. Okay, so that is the formula. All right. Again, remember, yeah, the DFL you already calculated at the earlier question. This one, 1.75. So 1.75, which is equal to. Okay, look at the question back. If EBIT increased by 35%, EBIT. So that means EBIT is here, which is 35%. The question is how much the percentage change in EPS. That means here. Okay, you need to find answer for this one. Okay, in this one, since it involves multiplier, that means multiply. So you don't have to do divided by 100 and so on. All right, percentage change in EPS means that this 35%, bring it up here and then you multiply. So that means, yeah, 100.75 multiplied by 35 straight away. You don't have to divide by 100. which is 61.25%. Okay, if you do not believe this answer, it's okay. The answer is 61.25 divide by 35%. You still get the answer of 1.775. There is a question number. I minimize this one so you can. Okay, question E, the last part. Okay, so question E stated that if sales should increase by 45%, how much will EBIT increases? So we have sales and EBIT. What is the formula that relates to sales and EBIT? Okay, sales EBIT. This one cannot because EPS EBIT. This one EBIT sales. Okay, because EBIT sales, right? Yes, yeah, EBIT and sales. Okay, you can use DOL. But for this one, EPS and sale. But here doesn't have EPS, so you cannot use DTL. So you should use DOL. So DOL, yeah, the formula will be percentage change in EBIT divided by percentage change in sales. Okay, for DOL, here you got this answer already, which is 1.71. Just bring it down, okay, which is equal to okay, percentage change in EB. Sorry, going back to the question. If sales should increase by 45%, okay, 45%, this one sales. And then what is the percentage change in EBIT? So, again, 45% you need to bring it up here. Okay, which is 45 multiplied by 1.71. You get 76.95. Okay, so that is how to answer the whole set of the financial leverage. Okay, it's a simple one. Just follow the formula, and then for the last two questions, you need to match up the formula with the components of the questions. Yeah. Okay, so right. Any questions so far?